All right, I'm going to get started. So welcome to the panel today, getting projects out of the ground and off the ground. And if that feedback's going to be going all the way through, I can stand up at the lectern if you'd prefer. All right, well, we're coming to you from Gadigal country, and I'd just like to pay my respects to their elders past and present. My name's Toby Whincup. I come from Wajak Noongar land in Western Australia, and I'm going to get my panel to introduce themselves and just give me a snapshot of what you do and where you do it.
Starting with me?
Sure.
Yeah, Bert, Koth. I'm a partner at Denham Capital, which is a private equity firm focusing on developing mining projects into production. We do this globally. We started in the US, and we have an investment footprint across North America, South America, Africa, and Australia. Here in Australia, best known as Pembroke, which is a large metallurgical coal mine in Queensland.
John,
Hi everyone, I'm John Welborn. I'm the chairman of Fenix Resources Limited. We're an ASX listed iron ore producer in Western Australia. 4 years ago, we commissioned our flagship Iron Ridge iron ore project. We're currently producing 1.4 million tonnes per annum, hauling that by road 500 kilometres to the port of Geraldton, so just north of Perth, not up in the Pilbara like the other big scale miners. And the relevance of this panel is we just recommissioned our second mine, and we're in the process of permitting and constructing our third mine in the Midwest of WA.
Mucsi. I'm from the state government, South Australia Department for State Development. Our team, what I'm heading up, is responsible for investment attraction for the resources, which means renewable resources, wind and solar, battery energy storage system, including mineral resources, critical minerals, rare earth elements. The second subsector is the fuels, natural gas, hydrogen, and all commodities, including synthetic gas and sustainable aviation fuel. And the third subsector is the clean technologies, where we are keen to secure manufacturing capabilities for South Australia. Hopefully my relevance to this panel will be to talk about how we see the government's role to help project developers and investors to proceed and deliver projects for our country.
Squire from Acorn Capital. Acorn Capital is a microcap fund. We invest in companies that go through that development phase from discovery through to production. So really talking on this panel today is really at the heart of what we do. And so as an investor, we see companies that do it well, and we see companies that manage that transition really poorly. So really keen to discuss it and impart some ideas.
Hello, I'm Jonathan Dunham with Black & Veatch. We're an engineering and construction firm that really provides infrastructure solutions to the mining space, among others. Really, my part on the panel today is to talk about how we enable all different tiers of miners to go through the FAL process to make sure that their projects progress and they're able to get through the FAL stage gates and get off the ground. Sorry?
That'll wake you up. He's just flown in from America, so that'll help. All right, we don't have a lot of time. We've got a great panel, and I thank you all for making the time to come here as well today. But just to get started, I want to set some context as why this is such an important point of discussion. And I think you'll hear common themes throughout the next 3 days. But look, at the risk of oversimplifying the challenge we've got ahead of us, across the next decade, we've got to find a way to get 4 times the amount of metal out of the ground than we are currently today. What does that look like from a capital spend? Well, to enable that, we need $500 billion to come into the market in the next 5 years, and over $1 trillion in the next 10 years. We're seeing a lot of talk around the various bilateral and multilateral relationships around the world and government initiatives to try to set up and secure sustainable supply chains and critical minerals. So everything's looking pretty positive from an opportunity to develop mines. But in spite of all of this, it's getting harder to permit, it's getting harder to finance mines. On average globally, it's about 10 to 20 years. So in order for us to get to net zero by 2050, we've got to find a way to accelerate that. And just a little bit of insight from an ERM study that we did last year. We looked at 170 critical mineral projects in the asset pipeline from 2017 to 2024. Of those 170 projects, 90% were represented by junior and mid-tiers. The majors represent less than 10% of the project pipeline moving forward. Of those 170 projects, 60% were delayed materially beyond their original estimated time frames. And the three key reasons for that: permitting was number one, below ground technical issues was number two, and tied in third place was access to finance and stakeholder opposition. So, in spite of all of this and all this opportunity, we really are challenged as a sector to enable the energy transition. So John, I'm going to come to you first with regards to this, and you've been involved in mining for most of your career in leadership and executive roles. Does this summation of the market and the challenges ring true to you, or am I missing something here?
Well, I think the stats speak for themselves, and thanks for the opportunity to speak first, Toby. I noticed that I'm the miner on the panel, so my traditional role is to complain about red tape and the over-involvement of government in mining oppositions and how our contractors let us down and how investors don't understand the challenges of permitting mines. And you mentioned I've had a long career in mining. I started out as an insolvency practitioning accountant, and then I was a debt provider as an investment banker, and then the last 15 years or so I've been a miner. I remember as an investment banker watching panels like this and listening to miners all agree with each other how they should be allowed to blast things up and blow them, and heritage concerns were completely irrelevant, and don't people understand we need the metal and we need to dig it up now? And thinking sort of Mandy Rice Davies wise, well, you would say that, wouldn't you? So unusually for a miner, I'm going to say that yes, it rings true, but I think Rick really said it, which is that there are management teams that do permitting well and there are miners that don't. You know, I spent most of my career in Africa, and I went to Africa because I'd been distracted by a career in professional rugby and thought I needed to go somewhere where no one was, into a blue ocean, because obviously Western Australia, my hometown, would be too competitive and all the good opportunities would have gone. And belatedly, really out of COVID, I'd realised that in fact there are huge opportunities in Western Australia, and it's a fantastic tier 1 jurisdiction for mining. Notwithstanding that, recent activities in the industry, if we broaden it out, if I'm representing miners, which obviously is a little bit egotistical and a bit of a jump, but in a state where Rio blew up Juukan Gorge and where we have really obvious governance issues, it's a bit rich for a miner to say that there's over-regulation. I think these things are a cycle. At the moment, there are real challenges. 20 years to build a mining project is just far too long. There isn't a mining project in the world that has a positive NPV if you started at -20 and capitalise those development costs. So there are challenges, but it's really about getting good actors and being correct in your investment ideology and process. There are, you know, environmental concerns, heritage concerns, mining permitting, key risks. 4 years ago, we commissioned the Iron Ridge mine in 6 months, not 20 years. In the last 6 months, we've recommissioned the Shinoorn iron mine, and we're in the process of getting final permitting on our third mine. So I think Fenix is showing it can be done, but I think it's being done, hopefully, in not an arrogant way, by understanding the regulatory environment, being empathic as to why stakeholders are looking for more regulation, and perhaps perhaps owning some of the shortfalls of our industry, rather than just complaining about the need to, you know, be responsible for some of the bad actions that have occurred.
So understand your regulations, understand your stakeholders, and work proactively to navigate the feedback around that.
Yes, no, that's not to say it's not. It isn't a frustrating environment in some regards. I think the reality that you framed and the question around the need for an increase, particularly in strategic metals, is a huge opportunity to refine the regulatory process. Necessity is the mother of invention, and we are moving into an energy transition, and we're moving into a far more uncertain geopolitical environment, which actually creates the opportunity for miners to be part of the solution rather than being part of the problem. But to be part of the solution, we need to actually be responsible for where we've gone wrong. And make sure that we are appropriately driving rehabilitation outcomes and make sure that we are recognising heritage concerns and environmental concerns as an industry. Because although this panel's focused on the development of assets and permitting, the reality is there's the potential over-regulation of those pathways is really in response for where there's been failures in the industry.
Yep, absolutely. So I'm going to come to you, Bert and Rick, next from an investor perspective, and just reflecting on that stat I mentioned earlier about 90% of the critical mineral asset pipeline is juniors. I'm going to ask you a two-tier question here. You can answer it any way you want. First, from a company perspective, why do some companies in the junior market fail when others succeed from your perspective? And from an asset level perspective, what's really important to de-risk those projects? I'll go to you first, Bert.
Well, I mean, company failure is either management failure or asset failure ultimately, right? So, I mean, I think if you have a good asset and you have a good management team, then usually you should be able to find the money. Having said this, we are in an environment where there's a significant capital contraction going on, right? Against mining development risk, and partially to blame are the high interest rates, right? Because if you want to triple your money today, all you need to do is to buy BB rated high yield bonds, reinvest the coupon, right? And you have liquidity all along the way. So there is an argument that to mobilize the capital that is required, the equity returns and the debt returns will have to increase significantly. Yeah? I mean, there's maybe last year in total, according to our statistics, $5 billion have been mobilized by junior and mid-tier mining companies developing their assets globally, and that's debt and equity combined, and that's a rounding error of the capital that's actually really required, right? Yep. So
that's next to nothing, really.
It's next to nothing, right? So I mean, there will be junior mining companies who fail in their development aspirations simply because there's not enough capital in the room to start with, right? But having said this, good management combined with good asset, in many cases, not always, but in many cases, will be able to find the money, right? And typically, when either the management is not good or the asset is not good, it typically results in failure, right? So I think that's the answer of your question.
Yep.
There's a lot of management teams out there running mining companies who in reality shouldn't be running anything, right? So that's part of the problem, right? And there are a lot of assets out there who, frankly speaking, are not good.
Yeah.
You know? When you actually look at it, when we look at least, because we typically finance the bulk of projects ourselves. We spend on a project hundreds of millions of dollars sometimes. So when we due diligence opportunities, it's under the spect of realism and not under the spect of equity promotion, right? So the things we have to make sure that it's a real world outcome is getting delivered, right? And in the real world, when you build these things, there are capital overruns, there are problems, you know, there are all these issues, right? So you have to bake in sometimes a 20-30% capital overrun from get-go ultimately, right? But why do companies fail? Scarcity of capital, bad management, bad assets. That's typically it.
And some of the due diligence we're seeing now, it's been a bit of a shift in the last sort of few years, is that management experience is one of the first things that's looked at.
Yep.
Have they developed projects before? Do they know the markets they're selling into?
And the truth is, there's very few people out there today who have 20, 30 years of experience building these projects, who are still hungry, right, to do it. You're talking about a very, very limited universe of people, and the scarcity of people in the pipeline who actually know what they're doing and who are still willing to do it. That's actually one of the biggest challenges that this industry faces.
That's a great point around that experience that can come to projects to make sure they're successful. Rick, have you got anything to add around that? Or?
Yeah, there's something I'd add to that is really the importance of understanding equity capital markets as an investor when you're in a small company. And when you look at the experience base of people, you know, if someone works for a big company, whether it's a BHP or a large mining company like, I don't know, Perseus or Amelius, you know, they get fantastic experience in terms of, you know, discovery and project development. And so what often happens, those people then take that, but they have actually no equity capital market experience, yet if you're a company that makes a discovery, whether it's in gold or it's in lithium or rare earths or whatever, there are very few people that have actually got that experience of going out and raising large amounts of capital in a very short period of time. And while that's easy to talk about, it's actually very difficult to do because there's a lot of gamemanship that's going on in the market, because you're trying to raise a lot of money. The market knows that. The share price is going up. They're trying to trade around that. And then you get the nuance of today, which is shorts then get into the market and they know when that raise is coming. And so what we're seeing now is that it's becoming really difficult to actually raise capital, large amounts of capital at the appropriate time in the development phase of that company. And so what happens if you don't raise enough money, you don't do the full feasibility work that you need, and that's when you get into a lot of trouble. So you might have a fantastic project, but if you're not raising enough money at the appropriate time, you get yourself into a real corner. It's very difficult to get out of that, and we've seen that too many times. So there are too many examples of companies with great projects that are falling short in terms of that understanding. And so why are they failing? I would call a company that fails is they have a 10-cent share price when they make the discovery. Their market cap grows to $1 billion, but it's 10 cents at the end. Yeah. Well, that happens actually too often. So it's actually the last dollar in. So that's not actually generating wealth for shareholders. It's actually just generating wealth at the end of the chain. And the reason that happens on a quality project is that lack of equity capital market experience. And so it's really important to understand that and to really model yourself off the people that have done it well and generate wealth. And so examples are, people like Steve Parsons, what he did with Bellevue, what he's doing with Firefly right now, is that he really understands the equity capital markets. He's raising money not around news flow, as in I'm putting out a resource, then I'll raise, or I'm putting out a feasibility study, then I'll raise. He's just putting out news flow. He sees when the market's hot, he raises lots of money, and he's very clever in terms of how he messages and positions that company.
So adaptability around your messaging, being nimble around how you sort of message to the market, and your management team has got experience from technical perspective and also equity raising perspective.
Yeah, the only thing I'd add to that is not to be in a hurry to move into the study phase, because everyone in the audience has probably heard of the Lassonde curve, where you make a big discovery, the share price goes out, then you go into this valley of death through that development phase. If you have a look at Simon Lawson at Spartan right now, you say, well, he's got 85 million of cash, he's got a mine on care and maintenance. How many ounces are you going to produce? No one knows. He's never told anyone. But he's raised well in excess of $100 million, and he's never told anyone where he is on that development curve. So what he is, he's actually staying an explorer on that Lassonde curve, and yet he's raising money all the way along it. And Steve Parsons does the same thing. Tim Goyder and Alex Dorsch did it for a long time with Chalice. They went 3.5 years before putting out a scoping study. It was disastrous when they did, but it might have been disastrous, but their share price was 20 cents and they had about 20 million of cash when they made the discovery. The share price today is about $1.80 and they've got about 150 million in cash and investments, and no one's interested in nickel. Well, he still did pretty well because they understood the equity capital markets. They raised lots of money at the appropriate time, set themselves up to actually get that project successfully into production.
Super. We're going to change tack a little bit now. It's linked to investment and certainty. Money flows where there's certainty. I'm going to come to you about what the regulators can do and what governments can do. I know you're not a federal regulator, but if you look at the McPhillamys mine and that unexpected decision that impacted their project, impacted their company, and impacted investment sentiment in New South Wales, as we heard today. What's the South Australian government doing with regards to creating a certain environment, or an environment of certainty, I should say, when it comes to investment in the mining sector?
So let's start with the main sentence that permitting should be designed for a process for everyone's benefit. So permitting is not just a government hobby or activity, getting the papers, look them through and cross them or tick them. It's very important that the permitting process is a board game where a lot of stakeholders are playing together. This is important. So the South Australian government want to see that the stakeholder engagement, even with the landowners and other supply chain developers, are continuous and not just one-off. So the Mining Act in South Australia is worldwide recognized act because all the elements and steps what we embedded in the act for the exploration license, for the mining license, for the PEPR, for program for environmental protection and rehabilitation, they are all requiring a continuous stakeholder engagement. This means that the stakeholders, not just information sharing with each other, but also having the concerns, and they can address and mitigate potential risk. The landowners always wants to know what is going to happen on the land. Who is coming to my land? Will they be drilling or what they are going to do? It's a concern. We need to understand that what risk should we handle. And it's not just the environmental risk, what we are talking about, but also risk on communities. So our main aim, we are very keen to make sure that we can maximize the benefits of the project proposal while we are really minimizing the risk on environment and as well the communities. The South Australian government is relatively small government. It's easy for us because the regulators are extremely well connected. Doesn't matter whether it's an environmental protection authority or Department for Energy and Mining or state development. But one very important thing is what our miners, big ones, junior ones, mid ones, really love working with us is a case management support, what we are providing. We are holding hands from the very first moment to understand the tailored different needs in order to avoid potential unfavorable decision like the Section 10, what's happened with the land access in New South Wales. We believe that if we exactly understand what risk should we handle, we can have the project proponents to handle those risks. But also as government, we have the opportunity to promote this project, which is also important because when the government is talking about certain project, investor might feel a bit more certainty and confidence because the government said, oh, it's a good project, it must be a good project, let's talk about. It might not go anywhere down the track, but at least we have the opportunity to facilitate connections and introduction with these people. And I just returned from Japan. We had a trade mission last week, and we had a meeting with JOGMEC. JOGMEC is a Japanese minerals and now hydrogen and all commodity-related Japanese government-owned body, let's say money, the money bag. And their question was right immediately that how the government sees the risk in different projects. They want to see how the company, what's the company capability to manage those risks, whether it's not about the financial model they are interested in whether they will be facing any community opposition or any regulatory hurdles. Because if they see that this is streamlined and the government clearly understands what the project outcome should look like, they will get more certainty. So we believe that it's absolutely all about communication, education, and getting all the details on time with a very well-designed process. The government has a very rigorous approval process. So I'm not saying that we are very friendly, but we are very rigorous. And the approval process is happening on technical and scientific basis. But this is the only way how we can make sure that project developers are able to deliver the project and they can handle and manage risk.
Super. Thank you for that. And glad to hear it was a successful visit to Japan and Korea for the mining sector and the South Australian government. That's great. I'm taking you all on a bit of a journey here. So we've got a good asset. We've got a good management team. We've got our project permitted. finance is flowing, but that doesn't necessarily mean you're out of the woods. Now, Jonathan, in your role as EPC and construction and operation of mines, what have you seen around the world with regards to things that can go wrong once you've got all of that in place? You got any examples?
Well, I think one of the things that's been getting more and more complicated is as far as the infrastructure challenges that some of the assets face. As far as when you're trying to develop your mine, it's not just about the asset itself, it's also the power and the water that are needed. And in certain communities that can be real problematic and issues. You know, in Australia, there's the discussion of country water. In different parts of the world, we've been involved with projects in Chile, for example, where getting off of country water was a key component. And so making sure that miners are paying, and these projects are looking at, okay, how can we make the project successful? How can we ensure that we have the resources in order to conduct our operations, and building those in, because those are not small investments. And so we really looked to make sure that as projects are going through, those questions, you know, are asked and answered and de-risked as well. And that, back to the regulatory and stakeholder investment, that goes to early identification of solutions and communicating with the communities about how that's going to be handled. You know, one example that we were involved with was with BHP on Escondido over in Chile, of making sure that they were going to be able to get off country water through the use of a desalination plant, but then also not impacting the local fishing community by disrupting, you know, the shoreline and stuff. So we came up with an alternative, which was first of a kind in Chile, to use micro-tunneling under the ocean to do the intake and outfalls, to provide the community with what they needed without being a negative externality to them, to provide BHP with the water that they needed to do the expansion and run their concentrators. And so really stacking those wins by early identification and investment in those solutions.
I think there's two things there that jump out to me. One is that role of mining in innovation. You talk first of its kind in Chile with regards to desal. I mean, those stories need to be shared more, because I still think that a lot of the community and a lot of the stakeholders around mining don't see the value that they bring, the sector brings beyond just jobs, taxes. There's a whole lot of innovation growth that comes through mining. I think the other thing that's important, and it's a shift, particularly for the juniors, in that they're often not stranded assets, but power and water is becoming a CapEx rather than an OpEx. So understanding that and factoring that in, I see you're nodding. How do you take that into account?
Well, look, I'm still re-evaluating the topic of the panel after Rick's comments, which I think have reminded me of a couple of challenges for miners. So, Rick, if I hear you correctly, you know, one of the really important things is actually deciding when you kick off a project, managing the equity capital market risk, particularly for a listed company. So, you know, if I reinvent that in the terms of the panel, which is how to get projects off the ground faster, it's in fact don't start. And I'm only being mildly humorous. It does remind me of the first conversation I ever had with Bert, which is 15 years ago, where he said to me, I'd gone to him looking for capital for a junior iron ore miner in Africa, and he said, we don't fund listed companies. You spend too much of your time trying to appease the equity capital markets. We actually want people who are busy effectively building mines and working out how you exchange rocks for cash. I don't know if you've changed your view. And just to tell a story about what I'm trying to illustrate, 10 years ago, I went to Anglo-American, or Kumba's, commissioning of the Kulamea iron ore mine in South Africa. And it was a brand new mine. And they were there, I was there with their exploration team, who I'd shown my projects up in Congo, and they brought me to this big event, and they were opening this big iron ore mine, brand new. And someone was up on stage highlighting how it had been a very rapid development, you know, from breaking ground on the mine. It's only 18 months ago and we're now commissioning it. And the exploration guy leaned across and whispered to me and said, do you know when we put the first exploration hole in this asset? And I thought, I don't know, no, this is in 2014, maybe 2005 or 2006. He said 1964. So that was, Anglo-Americans' rapid development of the Coolamaya mine, which, Rick, your point is, don't promise, if you're 1964, you said, we found iron ore, we're going to build an iron ore mine, then it's, 70 or 80 years away, it makes 20 years look quick. Whereas if you run that Lassonde curve, I suppose the more constructive comment is, don't overpromise and be clear about managing the market. And if you are in the listed space, then there is a real importance of the management team correctly funding the project and hitting those milestones at the right time. I think it's a real challenge, to match those two things as a miner and be genuine about. I do look at the allocation of capital. There are 800 junior resource stocks in Western Australia. Most of them have got larger management teams that I'm currently running at Fenix, and we're a producer of iron ore. And most of them are actually not in the business. Something I learned in insolvency is that most businesses, in fact, the number one explanation of almost every company I ever worked with in insolvency was that the management didn't understand the business they were in. And exploration, the flip side of the challenge, Rick, about understanding the equitable capital markets is often that's actually in contrast to actually recognising that the only value that is genuinely created in the long term is when you are exchanging rocks for cash. If you're an explorer, developer and a miner, there must ultimately be revenue from selling rocks to someone. And while you can mine the market and you can mine the equity capital markets and you can stay in that exploration phase of the Lassonde curve, sooner or later you've actually got to get a project off the ground, otherwise it's all ephemeral. And I think that's the challenge in this environment is there are lots of examples of people who can create value in equity capital markets. But ultimately, I'm probably, yes, I'm going through my career coming more to your comments 10 years ago, Bert, that what we really should be doing is, and certainly from a government perspective, and what you're saying is you want your clients to be smarter and actually do better work. And what the government is saying is, we want actually companies to be across the stakeholder range. And I think coming back to my first comments, I think as miners, we've got to be better at actually being real and not mining the market, but actually mining the rocks.
Okay. All right, we're 5 minutes left. It'd be remiss of me not to mention ESG. How important is it to each of the panel members in getting projects off the ground and out of the ground faster? And is any one of those three more important than the other?
I'm not sure ESG makes a project getting out of the ground faster, right? But I would argue, ESG is a buzzword, but I would say that responsible mining companies have always taken this seriously in the past. There's negative examples that happen, like in any other industry. But you always, and you've told me this, John, a long time ago, the social operating license, right, that you need, you need to do the right things. You always needed to do the right things to get that, right? So, for example, if I take a look whether in the DRC, for example, we built the world's highest grade tin mine in the eastern DRC on the border with Rwanda and Burundi, right? Like for the first time ever school, for the first time ever hospital, for the first time ever electricity, for the first time a cell phone, right? UN rehabilitates a national park just because we are there. Otherwise, they wouldn't be able to do that, right? So I think when you do the right thing, right, that's a requirement. That shouldn't be something new that's all of a sudden fashionable. For responsible operators, that was always the case, I would argue.
Right. John?
Well, thank you for saying, I said that, Bert, but one of my first jobs was working at Investec, effectively in Australia for David Gonski. And he was incredibly strong in saying that doing the right thing is always the right thing for business. So I was actually repeating a lesson that I learned early. I've found it difficult to answer this question through the Fenix lens. ESG more recently has been very focused on the E and environmental management. Fenix, we burn 1 million litres of diesel a month. We haul iron ore on roads to Geraldton, and our mining trucks all burn diesel. And so I felt a little bit, perhaps unworthy of talking about ESG. But I've changed my tune. I think it is absolutely fundamental to answer your question really directly, Toby, but I'd really focus on the G. It links to the point I made earlier about our relationship with the Wajiri Yamaji, or how we're getting through permitting by actually being respectful and empathic to government, to the need for over-regulation. And certainly right at the moment, across Australia and certainly in Western Australia and certainly in mining companies, we need to really be real in the same way as I'm saying as mining companies about what governance really means. I've mentioned I've worked a lot in Africa. I expected that the corruption that you manage in Africa and the changing legislative landscape would prepare me really well to come back to a wonderful jurisdiction like WA and Australia. And I'm shocked and surprised at how, in fact, the behaviour in Western Australia is in some ways worse than the behaviour in Africa. And there's never a better time to talk about the G in ESG than right now across our industry.
Edit?
Government perspective, ESG, I agree with that. I don't think it speeds up the project up and running. However, we see a differentiator if a company does the right thing. The trading perspective might work out better, especially with the Northeast Asia market off-takers. So we clearly see this, that those markets are not happy, but willing to pay the premium for companies who has the right sustainability action and elements in their business. From government perspective, where we can support the ESG is really the E part and the light exploration part when we are talking about data gathering with the steering map, which is the South Australian map on mineral commodities, including added the renewable resources, the land ownership, which means that we believe that we can provide more details and more data, which will decrease the number of the hard exploration, so we cause less environmental impact because we are helping the companies to collect these details. But also the drill core library in South Australia with the rocks and specimens really gives a good tangible samples for companies not to drill another hole if someone already drilled a hole there. So we see that the government has a clear role on supporting the E. The governance is another thing. So government not really have influence on companies' governance, but what we can do is support their communication and doing the right thing. And the social aspect, what we see now, mainly I saw before in my European life, the social deliveries for communities, how the companies are partnering for the local communities to provide some tangible asset and involve them to the project and educate them, which really helps them to proceed.
Rick?
Yeah, certainly it's really important for investors because it's not actually our money. We're managing other people's money, and particularly for the big super funds that we invest on behalf. They really started to ask us a lot of questions. The point John was making, there was a real focus probably 10 years, 15 years ago on E and not too much on S and G, and really S and G have come to the fore, and we regularly get questions from that. But even from an investing point of view, these things catch up with you. There's a company everyone in the audience would know that's had a really serious drop in the share price on governance issues just this week, and as an investor that can really hurt. And so you look at those governance issues and they really have a big impact, and they can have and it's not just short-lived, it can actually be quite long-lived, that impact, and you can't have that disrupting your portfolio. And if you think there are governance issues, ultimately it's going to come back to bite you. So
it'd be interesting to see how they come back from that one, the one that you didn't mention.
Yeah.
And Jonathan, quickly closing out.
They're all equally important in my eyes. It's really how do we come up with creative solutions to stack wins between the communities, the environment, and the governance, to make sure that you can do the best for the project by stacking those wins and building coalitions where you're all working in the same direction.
Super. I mean, this conversation could have gone on for a lot longer, but please thank the panel for such a rich discussion and lots of experience they brought to the conversation. Thank you very much.